Have you ever wondered what the real story is behind a company's ownership? It's not some static number. It's more like a living, breathing narrative of profits, payouts, and all sorts of strategic moves. Today, we're going to decode the one financial statement that tells this exact story, the statement of changes in equity. So let's pull back the curtain and see how this whole story gets written, one transaction at a time. But before we dive into the nitty-gritty, let's just start with the big picture, right? When you own a share of stock, what do you actually own a piece of? Well, it's a stake in the company's net worth, its value after every single thing it owes has been paid off. And that stake? That's called equity. I like to think of a company as a giant pie. The liabilities, all its debts, are the slices that have already been promised to other people. So stockholders' equity is what's left over. It's the owner's slice of that pie. And this is the core concept we're going to be tracking. But here's the thing. That slice of the pie doesn't just sit there. It's constantly growing and shrinking. So how on earth do we keep track of those changes? Well, that's where a very specific financial report comes in, the one that tells the official story of ownership. This statement is basically a reconciliation. It's a bridge. It starts with the equity value at the beginning of the year, and then it meticulously lists every single change that happened. And finally, it gets you to the equity value at the end of the year. It connects the dots between two balance sheets. Okay, so this table right here, this is our roadmap. It lays out all the key levers that can change a company's equity. You can see how things like net income, profits, boost retained earnings while paying out dividends does the exact opposite. Let's start by digging into the most powerful of these drivers. All right, let's start in what I like to call the engine room of equity changes, retained earnings. This is where a company's own performance, its profits and its losses, directly hits the value belonging to its owners. The logic here is actually really simple and kind of beautiful. Just think of it like a running tally. You start with a pile of profits the company has already saved up over time. Then you add the new profits from this period, and you subtract anything that was paid out to the owners as dividends. What's left is your new total. That's it. So how does a company actually give those profits back to its owners? Well, the most direct way is a cash dividend. The board of directors gets together, they declare a certain amount per share, and boom, that cash flows directly from the company's bank account to its shareholders. And here's what that looks like in action. On one side of the accounting equation, the company's cash balance drops by $120,000. Now, to keep everything balanced, the owner's equity, specifically that retained earnings account, also has to drop by the exact same amount. The owner's slice of the pie got smaller because a piece was literally handed to them in cash. Okay, so let's flip to the other side of the coin. Equity doesn't just change because of profits and losses. It also changes when the company itself directly buys or sells its own stock. The most fundamental of these transactions is a stock issuance. A company needs to raise money, right? So it creates brand new shares and sells them to investors. This is one of the main ways companies fund their growth, and it directly increases that equity base. So let's follow the money here. The company gets $850,000 in cash. Now, for accounting purposes, this gets split into two buckets. A tiny, almost arbitrary amount called par value goes into the common stock account. The rest of it, which is pretty much all of it, goes into an account called additional paid-in capital. The key thing to remember is both of these are just different labels for the new value that's been added to the owner's equity. Okay, now for the opposite move. Instead of selling shares, what if a company uses its cash to buy its own shares back from investors on the open market? Well, this creates something called treasury stock. And here's how that looks. The company spends $100,000 of its cash. That cash is gone, so assets go down. Then, on the other side of the equation, that treasury stock entry acts like a negative number, reducing the total equity. By buying back its own shares, the company is effectively shrinking its own equity base, often in an attempt to make the remaining shares more valuable. All right, this next part can be a little tricky, but it's really important. What if a company wants to give out a dividend, but it wants to hold on to its cash? Well, it can issue a stock dividend, basically giving shareholders more shares instead of money. Let's break down how this is totally different from a cash dividend. Now, here is the absolute key. Notice how that value of $67,500 is moved out of retained earnings, but it just reappears in other equity accounts. It's like taking money out of your checking account and putting it right into your savings account. The total amount of money you have hasn't changed at all. It's just a shuffle. No cash ever leaves the company.
And you know what? The exact same thing is true for what's called a large stock dividend. Yeah, the accounting rules are a little different, but the end result is identical. It's just a reclassification. The total value of equity remains completely unchanged.
This table just makes the difference crystal clear, doesn't it? With stock dividends or stock splits, you see the values just shifting between the columns, all within the equity section. But that final column on the right tells the whole story. For all three of them, what's the change to total equity? Zero. No change. Only a cash dividend actually reduces the overall value of the owner's pie.
So, we've looked at all these moving parts: profits, cash dividends, issuing stock, buying it back, stock dividends. So what's the big takeaway here for an investor? What does this statement really tell us at the end of the day?
Well, ultimately, the statement of changes in equity is way more than just a list of numbers. It's the company's financial story. It builds that bridge from one year to the next, and it shows you precisely how the company's performance and its big strategic decisions translated into real changes in shareholder value.
But, of course, no single statement can ever tell you the whole story. It's really important to keep a few things in mind. First, this whole thing is based on accounting rules, not pure cash flow. And that huge retained earnings number, that is not a pile of cash sitting in a bank account. And finally, remember this is a look backwards at a past period. A company's value is in constant motion, every single day. And that really leaves us with one final thought. This statement gives you the official, audited story of how ownership value changed. It tells you what happened, but it doesn't always tell you why management made those decisions in the first place. And that leads to the real question for any investor. What's the story that these numbers aren't telling you?